here at the moment. We're getting hit by storms and rain and cold. So, looking forward to getting into tonight's webinar. I know it's one of your favorite topics, and a lot of people ask about it. And I think you've brought a lot of people on board with the journey with you, Tom. So we're looking forward to actually sharing some of your insights and your tips and tricks on it.
Yeah, look, we really like to talk about things such as Wyckoff. And one of the reasons why is because we really want to understand positioning in the market. One of the things, even if you're a beginner, which today is focused on beginner into intermediate, is that we really want to, let me just quickly turn that off. Sorry, you don't have to hear that. But basically what we're doing is we're looking at the perspective of where are the positions, how do I understand the markets better? How can I use naked price action analysis to build and cement a foundation for the rest of my instruments, whether that be indicators, volume tools, or anything else. Today, we'll actually look at some live charts as well and some recent examples, plus some up-and-coming ones where you can start to play the chess game in the markets. All right. Well, before we get into it, let's just quickly do a quick disclaimer. We'll see you in about 10 seconds. Okay, so today is obviously all about technical analysis, making it simple, identifying potential winning trades using the Wyckoff method. Of course, today we will be looking at how do we understand the kind of core principles of Wyckoff, what little tips and tricks can we learn from it, what have we done in the past where we've made a mistake, possibly where have we done something that made us potentially more profit or better trader. And by the end of today's session, I'd like to think that you're going to be able to potentially start to integrate some of these ideas into your own trading concepts. And whether Wyckoff's right for you or not might be something you can do. We always encourage as well, ask questions throughout. We will answer them. So just put in comments into the live chat, or of course, ask us in the comments after the show. And that's always a great way to do it. Okay, so mastering Forex. Can we unveil the power of the Wyckoff strategy on day trading, scalping, and swing trading? Well, quite simply, Ty, it was originally more of an investment philosophy, but it can be used incredibly effectively for finding turns or changes in trend and even continuations in trend. So today we'll be taking a look at how do banks and institutions actually enter the positions using something like a Wyckoff method, a live example breaking down the market structure of these types of news events, and of course also a basic yet effective way that we can start to recognize Wyckoff from a much faster standpoint than others can. Will we be able to do it? I believe we will. So let's get into our first quote, which we always go, which is, of course, Wyckoff's most famous quote, which is, successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with one side. Now, Ty, over the years, I've done a lot of, today, actually, at the time of this recording, we found out that Charlie Munger died, which is very sad news. And I guess he had a pretty good life. 99 years is a pretty good run. But I was actually doing a little bit of a discussion about some of his quotes. And I think it's really a big thing here for Wyckoff as well, and for any of these quotes, is what we find is a lot of these professionals, a lot of these really high-end, great minds throughout history have been able to tell us very similar things with very basic quotes. Of course, one of the famous Charlie Munger quotes is, it's better to buy a great company at a good price than a good company at a fair price. So the thing is that it's a good company at a great price. So basically what that's telling you is it's better to buy when you are buying strength and you're buying quality. And even if you're getting less of a discount, it's better to buy quality than to go bargain hunting. And that's the same in collectibles. That's the same in almost everything. If you think about the best properties that have gone up the most over time, generally it's due to scarcity. And generally, it's those really expensive properties in Vancouver, yeah, Ty? Sydney,
that's right.
Vancouver or whatever it is in Sydney. But you know what I'm saying? Like it's always about those types of things. It's the same with stocks. It's the same with investment vehicles around the world. So Charlie Munger told us that. Wyckoff tells us it's a study of force. And of course, my favorite, Druckenmiller, also tells us the same thing. This quote here is literally the same quote, in my opinion, than Wyckoff's quote, which is the first thing I heard when I got into the business, not from my mentor, was bulls make money, bears make money, and pigs get slaughtered. I'm here to tell you I was a pig, and I strongly believe the only way to make long-term returns in our business is that are superior is by being a pig. So basically he's saying you got to think a little bit differently about the market. You've got to find which side has the greatest pulling power. Sound familiar? It's the same thing as Wyckoff. So these two guys, they really did have some amazing insights, just like a lot of these great quotes do. And I think we'll bring it more into our shows as well. So make sure to stick around and subscribe to the channel for that type of stuff, because we'll have some really great quotes over the next coming weeks that I think are going to help you in your investment and trading journeys. Ty, I love those two guys. Do you have any quotes that you'd like to, that you remember off your head that you really like in investing and trading? Putting you on the spot?
No. And the only reason I say that,
can I give some more?
I will say it, and I will say it wrong, and I hate saying it wrong. So you got me unawares. So I can give you one of my own quotes later if you like.
Sure. Okay. Well, I'll have it now.
Yeah, quotes are good because quotes actually form a way of reminding you what you probably should do, and I think it's a really simple way sometimes to put into words what you actually should be doing without actually, and then I think you automatically think about it, and that's probably the biggest point on quotes. You do remember, some of them do stick with you in life, not just in trading, but I think when you make up your own set of rules, if you like, a bit like what we're talking about today, if you can turn it into a bit of a quote or a little bit of a saying, you will never forget it. And I think that's really, really important, because it'll be the forefront of your mind every time you go to place a trade, or every time you're thinking about the market in a particular way. That quote will come to mind. It doesn't matter if it's yours, as long as it's right. Yeah. So
it's like, look, insight is the big thing. I mean, the funniest, or one of the funniest quotes, both from Munger and Buffett, was always rule number 1, don't lose money. Rule number 2, don't lose money. And you might think that's a really basic method, but actually what it's telling you is it's got a really deep understanding, doesn't it, Ty? And that does. You lose, you want to be able to compound your money up. So you don't really want to take too many losses, because it's harder to get back a loss than it is when you're compounding and, of course, making profit. You've done some great videos on that in the past. So anyway, let's talk about Wyckoff's laws, Ty, and the laws of supply and demand. We live by these in terms of just general society and economics. We've already seen demand outstripping supply quite a lot in recent years, thanks to inflation and obviously the heavy stimulus that's been in the economies. And it's the same thing in the markets, isn't it? So if we have a huge amount of demand and it's outstripping supply, what's going to happen? The price is going to rise. If we have demand underneath supply, the price is going to drop. It's pretty much just basic economics 101, but it's represented in price action, isn't it?
Yeah, most definitely it is. And price action gives us the biggest clue of them all. No matter what indicator you're looking at, price action is the one that is going to give you the most important information about what's happening right now. And you know what? If you want a quote, I'll give you one, damn it. Trend is your friend, Thomas. The most simple of them all. But again, like we said, if it's at the forefront of your mind whenever you're placing a trade, automatically you think to yourself, is the prevailing trend in my favor, yes or no? Isn't that similar to what Wyckoff and Druckenmiller are really saying? The where the pulling power is going to be where the trend is. And for some reason, a lot of people seem to want to trade against it. They want to go counter trend. They want to try and break what is actually working, Tom. And I think that's probably the important thing. So something as simple as remembering almost instinctively that trend is your friend will always force you to look at the market in a way where maybe you could have the opposite boot on, rather than just automatically jumping into your trade. You're going to look quite decisively at where is the real trend going. And if that gives you a clue and can keep you out of a bad trade, then that quote will do its job. But really, in essence, it's saying the same thing as your two favorite mentors.
Yeah. So when we're talking about the ends of trend as well, and we're starting to think about, can Wyckoff help us with that, or even in continuations, you'll often see markets that are starting to go sideways. A good rule to start thinking about Wyckoff is a 1-1-2-2. So the top tip today is, if you see one touch each side and then two touches each side, that could be a range-bound market where demand is equaling supply. Now, this is, of course, the first law of Wyckoff, and what it did was it told us that we were in a market that was possibly getting ready for another big move, and we need to study that force as well. Now, that could be in the trend. So remember, there's a distinct possibility you could have a trend up, you could have this, and then you could see that. And if you did see something like that, actually that is part of a Wyckoff method. And of course, it's something we'll talk about later in the live charts. So let's now discuss one of the other Wyckoff methods, which is the law of cause and effect. Now, Wyckoff's second law stated that the difference between supply and demand are not at random and instead came after periods of market preparation. So again, what happened? Well, markets would come down to a level or go up to a level, and they would prepare for the next big move. And a lot of the time, you'll actually see these types of structures actually formed in candlestick patterns, such as the long or short leg doji, which basically indecision candles, or as I like to call them, equilibrium type. So in Wyckoff's terms, a period of accumulation, it was the cause, which could lead to an upward trend movement, which would be the effect of the cause, or vice versa for distribution. So if we had an accumulation, there's our cause. If we broke to the upside, that would be the effect based on positioning from Wall Street. I think it's a profound, again, understanding there in that concept. The last one here in terms of Wyckoff's major laws was the law of effort versus result. And basically Wyckoff said that in the third law, he said that changes in an instrument's price were a result of an effort generally represented by trading volume. If a stock or a currency or a commodity, such as whatever, was started to consolidate with a very, very high volume after a long bearish or bullish move, then this high volume could signify a big effort. The move would be sideways, so it would be around here like that. However, when it reversed or it moved in the opposite direction or whatever was going on, the volume would indicate that there was a lot of traders there. And this is a profound understanding as well. Not all Wyckoffs are equal, are they, Ty? If they have this third law, they don't all have to have the third law, but if they do have the third law, it's quite a strong reading, isn't it?
Yeah, most definitely. And it really comes back to one of the things that we talk about a lot, which is the patience, react, don't predict. And that really is, summing up what is actually happening in the market and waiting for that reaction and waiting for it to kick off before you actually do jump in. It's another, again, we come back to it. It's a very simple way of looking at the market and way of looking at how you trade. But if it gives you 1 second's pause, Thomas, where you have to actually just think about it for 1 second. And sometimes we learned very early on that sometimes, being a little bit trigger happy, which a lot of traders are, there's no mistaking that, can be, how many times, everyone out there, have you been able to, look at a trade and say, you know what, I'm in, and the minute you've placed that button to buy, you're like, oh, I didn't see that, or oh, I didn't see that, or I wish I had have seen that. That's what we're trying to cut out of your market, of your trading. When you look at the market properly and you try to, combine as many of these quotes as possible and drum them into your head, you're going to make better decisions. And I think that's what it's really all about.
Yeah, the top-down approach is really a great way of thinking about it as well. As you said, multi-time frame analysis, top-down approach. Speaking of top-down approach, what if we consider Wyckoff's third law, which is the composite man? So the composite man was pretty much, let's just think of it as us versus them, or us versus the overall composite man. The composite man represents the single entity of the entire market, and it helps us kind of take our, mind-boggling almost understanding of how many people are really participating in these markets and break it down to one simple concept. Basically as humans, as in our psychology, we can't take that many inputs. A lot of us think we can, but you will find in trading, you'll often get very frazzled. And that's why they say the KISS principle is quite strong. Keep it simple, smart, Ty, not stupid. Keep it simple, smart. And basically this is something where we look at it and we think, okay, all right, we need to keep these processes simple. We need to understand it in a logical way that makes sense. And Composite Man, I think, was an excellent way of understanding the market participants and then to start looking for things such as traps, etc., in markets. All right, so recognizing price action is obviously key to anything, peaks and troughs and peaks in terms of lowers, and that's the change of trend. But if you notice most theories, whether it's Wyckoff, whether it's some kind of Dow theory or anything, they all have very, very similar setups. So this is a classic case of a Wyckoff. And what a Wyckoff is really showing you here in this distribution is the market is coming up and then it starts to slow down, doesn't it, Ty? It starts to make a series of higher highs, but they're barely doing it. Then it comes down, it tests out the previous support or demand area, and then it rallies up and it makes just like a little bit higher high than the previous one. So with Wyckoff, a lot of people really take it super seriously and they go through the whole thing as a theory. I think as a beginner, you're really looking at just a few parts of a Wyckoff distribution. You're looking for the initial run. You're looking for some kind of buying climax in terms of distribution. And then you're looking for what I like to call the trap. Now, traps often considered UT or a UTAD, which are just basically breaks to new highs that are then flushed back below. And what you can do with these is that, remember, Ty said before, patience, react, don't predict. Words to live by if you're going to be a Wyckoff trader. And the reason is because you don't really know much until you see something like this particular candle here and this particular move where it pushes to a new high and then pushes straight back down. Now, you may not expect it to go right back up here, but somewhere in here is where you're probably going to start thinking about a short. And that's because you've got the evidence on the left-hand side to make that happen. So let's actually go through to a live chart. This is what Wyckoff schematic looks like. And basically we have this AR rally, or sorry, the SI rally. We have a buyer's climax, which was before what we saw. Then we get a sell-off. Then we get a UT. And then we have, in this case, the end of the Wyckoff. So if we go back to that example, let's just quickly mark them up. This would effectively be our SI. This would be our AR. This would be our BC. This would be basically another sell-off into that point. This would be a UT. And then you could even argue that's maybe a UTAD if it did make a new high, which it didn't. And this is pretty much where you're going to be able to make the decision, okay, I'm pretty sure I know what's going to happen. And when this market picks back up, you're going to be looking for short opportunities. As of only this point, though. Before that, it's a big question mark. And that's what a trader does. That's what a difference between a professional and a novice trader really is, Ty. They're waiting for their opportunity of edge, aren't they? We're always searching for that
definitely. Edge. You're going to be, it's very rare to find a professional trader or a trader that really knows what they're doing that is going to go in there, look at the market instantly and just place a trade. Most of the time, they're setting up, waiting for a setup to happen, having alerts to come up for them to say, okay, a particular situation is happening here. You don't win chess in one move, and trading is a little bit the same. You have to plan ahead. It's very, very uncommon for a trader, a good trader that is, a consistently profitable trader, to just turn on their screen and short the Euro USD or long the CAD just on a whim, because that's not really how professional traders do it. It's about a planned process, waiting for the setup to happen. And when that setup happens, then you actually act on the evidence rather than predicting what may or may not happen. It's the difference between taking it to the next level and being stuck in the I hope it works out stage.
Yeah, exactly. Well, let's have a look here at some live examples in the market recently that we've seen from the Wyckoff standpoint, Ty, and where we could start to think about a Wyckoff. Now, in this case, what we have is actually a selling market. So we've got the Australian US dollar for many Australians out there, or even people anywhere around the world. This has actually been a pair that's had an amazing trade on it recently, and you can see it's pretty large strength actually that's come through. Now, what's happened here is the market has made its movement down, and this is a daily chart, and then it kind of does this funny stuff at the bottom. Now, you'll notice that what this is effectively doing is it's selling off, then we get some kind of further sell-off that's some kind of selling climax, and then we get a new low over here. Now, Wyckoff was all about understanding that markets will build liquidity. So what does that mean? Well, if we need to build a really large position, let's consider that the composite man is real. We're beginners, and we're having to understand this aspect of the market is one giant entity that's against us. What does the market need to do? It needs to build position. It needs to get liquidity. It needs to have more trades on the market board. So how can it do that? Well, if it pushes to new lows, like such as from here, it pushes to a new low, what's that going to do, Ty? It's going to open up people to placing shorts, and people that were long at these points over here on the left-hand side, they are potentially going to get liquidated. Now, ask yourself the question, when someone is long and they're getting taken out, what does that buy become? It becomes a sell. Now, because of course, to close a buy, you've got to sell it back into the market. Now, if I'm selling it back into the market, who could be purchasing it? And this is where Wyckoff's genius came in, Ty. He talked about the idea of the composite man. Well, the composite man wants your position. So because they've pushed it to a lower point, they're going to come in and buy the other side. They're going to effectively buy the position and build a larger position, which is what they need. They need potentially billions of dollars. So they're going to have to get their position in. How do they do it? Create the liquidity. That's a fundamental change from what a lot of people learn in trading, isn't it? And that's where I think Wyckoff really starts.
Yeah, a lot of people will probably be aware of this if you're avid followers of Pepperstone's webinars and our channel, because we talk about this a lot. But yeah, it's very, very important to realize that the big institutional players can't place one trade like retail traders can. We've got a very, very big distinct advantage over the big players that we can get in and out of positions instantly at any price point that we actually want. Whereas the bigger position players, there's just simply not enough volume. So they're going to set these little volume traps in order to trick people into thinking that the market is going down. That's really, it is, we have to call it for what it is, Tom. It's a trap. And but that trap is playing into the hands of the bigger players, because we're providing that liquidity and volume for them to be able to fill their positions. And that's vitally important. That's why I think Wyckoff's theory is so important, because it's really telling and painting a true picture of what's actually happening. And I think you're right. The genius of that method really breaks down the market. And look, I must admit, it took us a long time to find this. We weren't looking at this, 15 years ago when we first started. We were actually all about trying to beat the market. We would have been the ones shorting at the bottom of that. But when you understand what you need to do and work with the market players rather than against them, it really opens up a whole new world, and you start to look at the charts very, very differently, don't you?
Yeah, well, that's exactly. And that's why it's important to have that top-down approach as well. So let's just consider, okay, we might be interested in trading a 1 hour, 2 hour, 4 hour chart, whatever. Maybe we want to get into some swing. So at this stage, of course, what do we know? Well, if we go out to a monthly chart, we can see that previously around this level, and if we keep scrolling out the Australian dollar, this is a point where we tend to see, and you'll notice this quite a lot, we tend to see the Australian dollar making a significant shift. Now, you're not always going to find such significant levels, but the point is that this is a significant level. You can tell that on a monthly. Then we scroll into a weekly, and we can see again that there is some price action around here, and it looks like it's consolidating. Effectively, it's going in a range, then it's pushed lower. Do I know anything at this point? The answer is absolutely no. I don't know anything, because the market is just pushing lower. It's making a series of lower lows and lower highs. But notice there are all of these very significant candles. What are all of these candles, Ty? They're all pushing wicks down. They're all long leg dojis. They're all rejection wicks. And then suddenly there's this huge candle here that comes in before actually a news event. So this is before the news. And then we see a sell into the news, which gives us the opportunity to strike. So let's have a look at why we could maybe strike here. And what I've shown is I've put on two what we call volume profiles, which again is a basic method in markets, just to understand. You can get this with the Pepperstone Trading View platform. And what you need to do is you need to probably have, I think, a pro account or better in terms of Trading View, because you'll want to get your volume profile. But what this is showing you is all the orders that have been placed in the system. So you can see that here is the most traded zone. And then of this little range over here, it all seems to be fairly concentrated through that area there. So what that tells you is that when the market goes up from this point and it has that massive daily close on it or weekly close on it, that's significant, because that's taken out all of the wicks that are around here that we're pushing on the downward side. At the same time, Wyckoff always states that if we can see some type of trap, or we can see some type of push in liquidity, which could be the UT or the push to the new low. So here's the selling climax. Here's that trap component. This could tell us everything we need to know. And I think this, along with the rally that we get from that point, which is that giant candle, really tells us, okay, we should now be looking for longs. And this is actually something that I've spoken a lot about on our own channel as well, which is fxevolution.com. And the reason I speak about it is because this actually was happening live only a few weeks ago. And it was actually a very good Wyckoff setup that then could have been correlated into a smaller trade period. Once you see the pullback from this point, what's our bias going to be from that point onwards, Ty, as it breaks back up? Is our bias going to be short anymore in the small timeframes, or is it going to be predominantly looking for bullish because we believe we have edge thanks to Wyckoff?
Oh, absolutely bullish. And I think that for many technical reasons, you're loving that zone. And you're right. That was a setup that was actually, these setups don't happen all the time at these golden zones.
No,
and it just so happened, this one was just a beautiful, beautiful place on the Aussie USD. But if you look for them, you will start to identify them, and you'll identify them on many, many different time frames as well. It's not always the bigger time frames. You will see them.
Yeah, so let's have a look at another one, because, of course, it looks like you're cherry picking when you look at things like that. So here's just an example of the US dollar recently. And, of course, the US dollar came up to a zone, and you can see here that we might have our SI, we might have our AR rally. Then after that, then we have our buying climax. And ideally, you would have seen a new high over here to give you a UT. Now, if that had happened, it makes it a lot simpler. But we can clearly see we're in some type of distribution that's Wyckoff. We can clearly see that volume remains relatively solid, which is Wyckoff's third law. You're starting to put together the pieces of the puzzle to say, well, okay, if this now breaks underneath this zone, remember we've got that trick, 1122. Well, we know we're in a range-bound market. We know we're potentially in distribution. If you look at the higher timeframes, you'll see you're at a key level, and then suddenly it breaks to the low side. Once this happens, Ty, it's really giving us a go-ahead to say, okay, there's a good chance that we're going to move lower to the next level, such as here, potentially here, or even lower again. So again, just a dollar index Wyckoff kind of example, which of course is correlating with that particular odd USD. I've got another one though that I want to show, which was the euro, and this is in the direction of trend. So Tyrone said before, what if we considered the direction of trend being our friend? Could we take advantage of Wyckoffs? So again, here we have a 1122 in terms of a very similar range. That tells us that we're in some type of potential accumulation. The trend's up. So if the trend's up, what do we want to be looking for? Ideally buys. And you'll notice that we have here this kind of set where it rallies up, it drops, it holds the same position, it makes a new low. Again, we make no decisions at this point. We don't know anything. And then it starts to accelerate off, and then it breaks this high. Now you can clearly tell that's news related because it goes off like a slingshot. But actually, the signs were all there, weren't they? Ty?
You're already there.
Probably they were around here.
Yeah. Absolutely. Yeah. We've been talking about that in the streams actually for the last few days, actually. Look, it was definitely there. The opportunities were there well before that candle went because the signs were there. And realistically, once you've got that 1122 lined up and the added bonus of the direction of the trend is in your favor, it really only gives you one way to look, and it's certainly not shorting.
Mm-hmm. No. And I think that's a huge component of what you're looking for when you're looking at these trades is you really want to understand, okay, well, if your trend's up and you're making a series of high highs and high lows, then we should really be trying to look in that direction. And can we spot Wyckoffs on the smaller timeframes? The answer is quite simply, yes, you can.
Yes,
you can see these things. There's literally one there. Let's have a look if there's one maybe in these other areas. You mentioned that you've been looking at it recently as well, and there's been other ones that have come through. So here's the 5-minute chart, and you can see that we've had a whole bunch of creation. That's a classic Wyckoff style where we get a pullback in the markets. It comes down, goes to a new low, goes to a new low, rallies up because it continuously makes that kind of triple low that you tend to see, which is that first initial sell-off, the selling climax, the final trap, and then the rally. And if you actually wait for like a 1, 2, 3 in this type of case, and that's often the way it is, it's kind of like a hump, hump, hump down. Once that occurs, if that's in the direction of a downward trend, very strong. So it's like a 1, a 2, and a 3.
Absolutely. And you've got to remember, it might sound simple that you say, oh, well, yeah, if you're trading in the direction of the trend, it's going to make your life easier. But really, when you look at it, take it one step back and think about that for a moment. If you know what direction you're going in, like Tom said, we're only looking for longs when these setups are happening. We know we've got the prevailing trend going long. Half of the decision has actually been made. You're not thinking about, am I going to short or am I going to long it? You're going to long it. All you're looking for is actually the opportunity to long it. So by understanding where the trend is going or having a really good idea of where the trend is going and which way it favors, half your decision's made, Tom. You can only go short or long in a market. You can't do can't do both, or you can do both, but you won't do it successfully most of the time. So
exactly.
There's only two directions that it's going to go. It's going to go short, it's going to go long. And when you know which direction the trend is going, half of that decision's already been made. So all you're doing is actually looking for an opportunity. Your mindset has gone from, am I going to short the market or am I going to long the market, to I'm going to long the market, but now I'm just waiting for the opportunity. So see how that mindset straight away is going to put you in a position of power because you already know what you want to do. You're just looking for the opportunity to do it at the best possible place rather than being indecisive and saying, I think I might short it if it does this or I might long it if it does that. You've got a pre-planned attempt at going a direction in the market. You're waiting for the right setup. And that's where the patience kicks in.
Yeah, and it's on all time frames. That is totally the way you should be thinking about it. So again, this is just a 5-minute. I've used that 1, 2, 3. There's some examples right now that could be happening on these markets. So let's have a look at the US 500. Now, every single person wants to try to short this market. You mentioned before, Ty, that that obviously trend again is your friend, and as you said, you got to be patient. But one of these things that everyone's trying to do is, as you said, everybody's trying to short it. Everyone's trying to go against this trend. It's true. If you look at the stats at the moment, I think it's the German 40. And I was just noticing here at the time of this live recording, We've got here the DAX jumping out 1%. Now, this is one of the most sold markets at this stage. I think it's 82% sold. So 82% of people have been trying to sell it pretty much from like in here. And you can see what's occurring. It's actually squeezing high. Now, when I say 82%, that's 82% of us, the general retail trader. And unfortunately, it's not working out for us. So what's happening here is that this is a clear resistance, a clear supply. I'm not questioning that. Neither's Tyrone. Do we like that level? Yes. Would we be looking for potential Wyckoffs and shorts and replications there? Yeah, we would, wouldn't we, Ty? We would. Yep. It just like to the short, we'd look, but that doesn't mean we'd touch.
But are we going to touch? Exactly right. Just yeah. And another saying, just because you can, it doesn't mean you should. You must be patient and wait for the evidence. Waiting for the evidence is one of the hardest things to do in the markets, but it's one of the game changers that will make a big difference in your trading. There's no question about that.
Yeah, and I mean, you can see here what's happened with this market. It's pushed higher, so we've got this kind of initial. We've got a new rally, and it's possible that if that had gone below here, that may have changed absolutely everything.
Changed everything at that point. Exactly right. But we were not given a sign in any of those candles that you can see inside that yellow umbrella that Thomas has painted there to go short. There is nothing is telling you to go short in that instance.
Only really small time frames here, and then that's going into this demand. So it's a very big struggle. Here is possible. Yeah. You can see there's a reaction, but it's just not strong enough.
Yeah, you would be hard pressed to short into a support level role reversal zone that is producing there. You got resistance at the arrow. That is not the place to be going short. Even though it might go short from there, that is not the place you want to be placing your shorts. You want that level to break first prior to actually entering the market. Let the minions do the work, and then you jump in and actually take the glory. So yes, if that level was broken, a very, very different lens would be applied to this chart. But it wasn't. And consequently, as you can see, 1% up. Out of what would be considered a very good zone. And people would say, well, yeah, that's also in hindsight. I hate missing those opportunities, but those opportunities are there for the taking. If you go to the smaller time frames, you will see them play out.
Yeah, I mean, you can drive these ones down into really small time frames and still apply the same method. Again, we know the trend's up, so then we can come in and have a look and see whether we've got some kind of Wyckoff creation. And generally, because Wyckoff is a structure of positioning, I would say that because it's structure, you're going to see it on many time frames. So it doesn't really matter whether you're on a 3-minute time frame. This is a good tip as well. 3-minute time frame, 5-minute time frame, 10-minute time frame, 1 hour time frame. Generally, the structure will be created over a decent length. So you're going to get the opportunity to be able to spot it on the markets. And it's going to be on all of those time frames across the board. We've got some questions coming in, which I'm going to answer right now, Ty. And the first one is from Alex, and it says here, how much does currency strength play a part in this week's or this weaker/stronger, or does trend win regardless? Well, I mean, basically trend would be already showing you currency strength. So what I guess you're saying is, okay, well, if you pin two strong currencies against each other, which one would win? Well, that's going to be much harder trade than pinning the strong currency versus the weaker currency across the board. And again, that could be on everything. I would say that you're just better off basically trading what you see, trading the structure. Yeah. And if you understand that maybe like at the moment, the US dollar is weak, or it has been weak, and now it's possibly a buy, but it's been very, very weak, then you would be able to say, well, all the pairs are probably going to go up against the US dollar. Which one is going to be the strongest versus the US dollar? And my argument would be the odd recently because of great creation.
Absolutely. I think what you need to do there is, you need to get your bias on what you think it's going to do, and then pick on a bit like, it's a little bit like if you're a bully at school, you're not going to go pick on the bigger kids. You're going to go pick on the smaller kids, right? So trading's a little bit the same in the sense that you're going to go pick on the weakest pair. So, maybe the euro-based pairs or the dollar-based pairs are the ones that are going to show the weakness. It doesn't mean you go and basket them. You go and find the weakest out of all of them and actually pick on that one, because that's the one that's going to yield you the best result if indeed you are correct in your assumption that the direction is going to be long or short. So you always want to pick on the weakest one, but that trend is already established at that point. I think that's what we're trying to say. The trend will already be established at that point. Then you use the currency strength to work out which one you're going to pick on. Pick on the little ones. Thomas was a big bully when he was younger. He used to pick on the little kids. And
no,
he,
maybe they picked on me. Anyway, no, I was all right. I was in the middle of everywhere. So anyway, let's continue to just look at a couple of currencies here and some commodities. So we'll bring in gold for an example. Now, gold's been historically quite strong recently, hitting into those 2050s. A lot of people interested in it. So what do we know? Well, we know the trend is currently strong. We know the trend is making it currently a series of higher peaks and higher troughs. And we also know that we have this structural level. So what if it came down here and it did this? Is that going to be a relatively strong potential Wyckoff to the upside? I'd say yes, because of course we get our preliminary support, we get our selling climax, and we get our trap component, the 1, the 2, and the 3. And really, it is kind of that with Wyckoff. You have to think of it as a 1, 2, 3 kind of concept. Now, has it happened? No. Could it happen? Absolutely. And that's what Wyckoff was also about. He's about, waiting, being patient, and recognizing areas that could be of interest in the future. And we were mentioning before that we like that odd area. That was an area I had set for months ahead of time of an area of interest. But just because it hit the area of interest doesn't mean I was instantaneously like, oh, it's time to trade that particular thing. Absolutely not. Absolutely not. Another thing that I think with all of these Wyckoff theories, Ty, and everything is that, remember, they can happen inside the trend, inside the continuation on the smaller time frames, or they can completely reverse a trend. If they're going to reverse a trend, generally you're going to see it more on the daily time frame, 4-hour time frame, that kind of time area. If it's in the side of the trend, you can really use the smaller time frames for that. It's going to be a much more accurate thing. Again, a top tip for scalpers, day traders wanting to implement this into their systems. If you do have any other questions, guys, please put them through right now because we will answer them. We've got quite a few of you that have joined us. And I do want to answer a question from a week ago, Ty. And it was about basically understanding, what pairs how many should I really be focusing on when I first start trading? So the question for a beginner is, okay, we've got a lot of instruments. What should we be doing? So we always have that slide that we talk about the majors, the euro US dollar, the pound US dollar, maybe gold. Possibly you wouldn't want to start with like a silver or something. You'd want to go with just the US dollar yen, or a lot of US dollar majors, maybe a couple of yen majors, maybe currency in your country if you're interested in that. Those are the types of things you'd start with. And you'd have like a base, I think, of around 5 to 6 would probably be a good place to start, because you are going to get overwhelmed. And you're better off becoming a bit of an expert at those. Yeah. So you're better off, focusing on it. Again, I like to think of it as we have Cocoa Puff minds, and we can't focus on too many things. Now, over the years, I've expanded to a lot of markets. But there are some that I still don't go into. So for me, it's not. I won't go into stocks. I just don't know.
But the difference is that we've done this for a very, very long time now, and we can make an assessment on a market extraordinarily quickly. We have to, because we do live streams every day. So we've got ourselves in a position where we can do that very quickly. But when you're first starting out, or you've only been doing it for a little while, becoming intimate with the pairs that you're currently looking at will give you a big edge, because you know what's normal and what's not. If a market's behaving erratically, you would know about it. Whereas if you've got too many in the basket, you don't really know whether they're actually behaving normally, which is a good time to trade, or whether they're behaving erratically, which is a time to stay right away. So it's really important to be intimate with the currency pairs or whatever you're trading that at the start. And then as your knowledge base grows and you become quicker at the analysis and understanding, then you can expand your horizons in terms of what you're looking at trading. And then you'll get even more opportunities. But remember, that every currency pair has 4 or 5 different charts that you can look at quite readily. So if you're looking at 6, you're really looking at 30 different opportunities in different timeframes, right? So you've got to be mindful of that. It's not just, you might say, I'm only looking at the euro and the Aussie USDs. I'm only looking at 2 currency pairs. How sad am I? You're actually looking at 12 different opportunities on different timeframes there. Or more if you really want to delve into different times. So just be mindful that everyone opens up. It's almost a subsection, isn't it, Tom? It's a sub-index of every pair that you trade, that there are other opportunities on the smaller time frames that may not be as evident on the bigger ones.
Yeah, and there's so much opportunity. I always say abundance mindset, Ty, is also a powerful concept when we're talking about these markets. So I guess that probably brings us to a bit of a beginner end here for Wyckoff. So if you like Wyckoff, if you think, wow, this is pretty interesting, then I'd encourage you to jump on over to Pepperstone's resources and have a look at some of the other Wyckoff streams that we've done. There's some helpful advice or helpful concepts in there that could help you as a trader and, of course, investor as well. And if we just answer this question here from Monetary Flow Tie, do you prefer the 1 hour, 2 hour, or 4 hour? I'm a bit of it. Look, I actually use the 2 hour a hell of a lot. I've got to be real. And I don't know why. I think it's just because it compresses the chart quite well for me. The 4 hour, I used to use heaps. Now I use it less. Ty, what's your favorite out of those?
Yeah, I'm still a dinosaur, so I still love the 4 hour and the 1 hour. Back to my MT4 days, where they were your options: 1 hour, 15-minute, 1 hour, 4 hour. The 4 hour is one of my favorites because for a structure to form, it's going to form over several days. It needs several days to actually give you a structure. So give you a lightning bolt, give you a supporting bottom, because obviously there's only 6 of those candles each day. So you're not going to get patterns forming. And when you're getting a pattern forming over a certain amount of days, you're getting a whole world's worth of markets and different sessions looking at the same thing you are over an extended period. So that's one of my favorites, the 4 hour. But again, that's a bit sentimental because that's what we've been used to and has been drilled into us from a very early start point. But there's a lot of merit in the 2 hour, and I do love the 1 hour for actual pinpointed entries. The 1 hour is a really good time frame too.
It's a great question, Ty, from Avery 100. I'm going to answer it first, I guess. Can each of you share your biggest 2 to 3 mistakes you learned early on your trading? All right, there's some big ones here for me. I think I'll go with first one was over leveraging straight away. I think trying to force trades and over leveraging was easily the worst mistake I made. That was definitely number one in terms of bad choices. The other thing was also not probably thinking about starting small. So what I mean by that is, I was trying to sprint rather than running the marathon. And that was something that I think is really bad with trading. Over on our website, Ty, on FX Evolution, you've done a Pressic account builder, which is totally free if you want to look at it. And what that is it's an excellent resource because it shows you that that you should only reward your trading account when you actually make a few dollars. So you've got it. Let's say you make 5%. Then you say, okay, well, I've made 5%. I did it in a replicable manner. So now I'm able to actually compound and potentially add a little bit more money to the account because I've done well. And I've shown that I've done well. So that's something that I think I really wish I did earlier, which was doing that. So I guess for my number one would be over leveraging and over trading. Or number 1 and 2, and then the last one would be, definitely for me, what I just said then. Ty, what are your worst mistakes?
Trying to catch a falling knife. Trying to stop a market from going in a particular direction is a very, very common mistake that a lot of people make. We made that early, no question about that. Revenge trading, Tom, is a killer. Revenge trading is an account killer. Not letting go of an idea, no matter what the market is doing, and trying to revenge trade out of it. Very, very bad. Double down, triple down, martingale the hell out of it.
I knew martingale was coming.
That is a big mistake that we certainly learned early on. But also, and they all coincide with over leveraging, which unfortunately, back in the day, leverage was just you could get it on a cardboard box, really, and.
2,000 to 1, Ty.
Oh, you could get whatever 1,000 to 1. You could do whatever you want.
2,000.
You could have $1,000 in your account and they'd let you trade 50 contracts. It's all good until it moves half a pip. So, definitely over leveraging is a massive problem. Catching a falling knife, trying to stop a market, and also, not waiting for the evidence. That is really, and revenge trading is probably the biggest one. Once we got those bad traits out of our trading, the sun started to rise, Tom.
I really do believe so. I think, one of the things that you could get away from that is how do you stop making those mistakes? Patience, react, don't predict. All right. Thank you very much, guys. There's a reason I put it on the top of these charts. Anyway, what I would say is thank you very much for watching. Give it a thumbs up on whatever platform you're watching this on, and let Pepperstone know you like it. Chuck a comment in the description as well. And some great questions there, I got to say. So thank you very much. Some thought-provoking stuff. Avery, Monetary, Alex too. Excellent. Thank you so much, guys. We'll see you next Wednesday. Make sure, description down below as well, if you want to sign up, make sure you're always aware of when we're going live for these things. And we'll hopefully see you for another Wyckoff session soon. Maybe it will be an advanced one, Ty. That'll be pretty sweet.
Advanced one.
All right.
Look out.
Thank you, everybody. Bye for now.
Thanks very much for joining us, everyone.